Hello and welcome to our webinar. Today we are going to talk about vineyards, horses, and all kinds of other alternative investments that we see. And if you've joined us for webinars before, you know that we're typically talking about things like LLCs, investing in real estate, gold and silver bars and coins. But really, because of the way the IRS allows different alternative investments, we have seen so many truly unique investments. My name is Larissa Greene. I'm with Advanta IRA, and I'm joined today by my partner, Corey, and we're going to take you through this webinar. How are you doing today, Corey?
I'm doing great, Larissa. I love this webinar. It's something for the audience that Larissa and I partner on typically about once a year, and we're really just here to express to you guys how diverse self-directed accounts are. And in doing so, we're really just kind of case studying and outlining and highlighting some of the really most unique investments we've ever seen. We've combined have probably 15, if not 20 years experience in the self-directed space. So hopefully we're bringing something great to you guys. If you have any questions, please use the questions box on your GoToWebinar panel, and we'll address those at the end of the presentation.
Great, thank you so much, Corey. And just also to let you guys know, we did upload the slides for you as a handout. So again, you can go to the right-hand navigation, drop down the handout box and download those slides so you can review them later. Yeah, as Corey mentioned, we've both been with Advanta IRA for quite some time. We've been doing education and business development. Here is our direct contact information in case you have a question that maybe you're not comfortable asking on the webinar. You can reach out to us independently. We're happy to help you with those questions. Advanta IRA has been in business well over 20 years at this point, and we have clients nationwide and even worldwide. We actually have well over $3 billion in assets under management at this point. But we have two offices. We're in Clearwater, Florida. That's our corporate headquarters, so to speak, and we're also in Atlanta, Georgia. But Corey is even outside of that area. You can find him in North Carolina. And so we actually do a lot of networking for Advanta IRA, but we can help anyone anywhere. So as long as you have a US-based retirement account, we can help you self-direct that account. So we have clients even outside of the US, as I mentioned. Something that's really important to us and really makes us stand apart from our competitors is that every individual with Advanta IRA receives a dedicated account manager who helps them with their account. And why is that important? Almost everybody that comes to us and opens an account is new to self-directed IRAs, and so they need help understanding the paperwork, the investment process, how their account will be handled. And so having someone that you can reach out to that's really going to assist you with those questions is very important to us. And so you have that dedicated account manager after your account is set up. And then of course, if you have an account, then you know that Corey and I are sort of your onboarding specialists. We're going to help you get there and fund the account. And then we're going to turn you over to somebody very capable of assisting you for the rest of the time you have an account with us. We're going to talk about the unique investments we see today, and we'll talk some about the rules that we know from the IRS for self-directing your IRA. But please keep in mind that we don't give any investment advice, legal or tax advice. Everything that we share with you today is for informational and educational purposes only. But if you have questions outside of what we're talking about today, please let us know. We may be able to refer you to a professional that can assist you with those questions. Otherwise, it's always a good time to engage your attorney, your accountant, whoever it is that might be assisting you.
So what is a sorry, go ahead, Larissa.
Yeah, go ahead, Corey.
Okay. So what is a self-directed retirement account? Basically, it is a retirement account with an alternative asset administrator like Advanta IRA that is not a fiduciary or a financial advisor. So we're not restricted to limiting your investments into stocks, bonds, and mutual funds. We let our clients invest into pretty much anything under the sun that you may either have specific interest in or have a expanded knowledge and know how to make these types of investments. A lot of times people don't know that self-direction exists, are already doing one of these investment strategies with their savings or personal money or other, funding resources. And then they learn, oh, I can use my retirement funds, my old 401k that's sitting with an old employer, my IRA that's in the stock market and I'm getting fatigued with the stock market fluctuations, and switch over to a self-directed strategy. So again, we don't limit what or how a client invests into asset-wise. We offer pretty much anything that the IRS allows is kind of our rules and regulations that we follow and help our clients with. And that includes real estate, private notes or paper assets, private placements, so limited partnership or syndications, precious metals, cryptocurrency, and much, much more. Again, today, we're not going to go into exactly those bullet points. We're going to go into some of the more niche experiences and strategies, talking through what the actual investment is, how it's structured from a standpoint that we would help the client with and facilitate, and really just bring a understanding to the table and to you as to how diverse and broad your retirement account can look if you want it to be. So if you haven't heard about a self-directed retirement account, that's actually very common. These self-directed accounts are very unique in that they're not as well known as I just mentioned. Only about 4% of US-based retirement accounts are being self-directed, and that's an industry with about $40 trillion in it, give or take. So of $40 trillion in the US-based IRAs, 401ks, 403bs, 457s, thrift savings plans, only about 1.5 trillion is currently being self-directed. That's a big untapped market of people that can take their funds out of, like I said, a fluctuating stock market, bonds, mutual funds, into an alternative asset class that may yield higher returns. I can't speak to specific numbers, but you could be in the stock market, maybe hoping to get 6 to 7, 8%, and you could find an alternative investment all but guaranteeing 8, 10, 12%, or even much, much more, depending on how risky your strategy and your risk profile is. Just because you have knowledge or expertise or interest in this unique area of investing. So it is important to let you guys know what type of plans we offer. Most people are familiar with your standard traditional and Roth IRA. Those are US-based retirement accounts. You do not have to have them tied to any specific employer or employment. As long as you generate taxable income that you file income tax on, you're able to have a traditional or Roth IRA, contribute into it up to the annual limit, and grow that, consolidate funds from old existing plans into that, and let it keep growing. Also in that same line is inherited IRAs if someone passed away and left behind their IRA to you. But we also offer other unique accounts like education savings accounts and health savings accounts. And for small business owners or self-employed individuals, there are plans with a bit higher annual contribution limits than your traditional and Roth and HSA and ESA. That would be our solo 401k plans and the SEP and simple IRAs. But again, those plans are for small business owners, typically with no or very limited rank and file employees. So if you're having a side hustle, if you will, or just a small business where you run your own type of firm, speak with Larissa or I. We can definitely point you in the right track for the plan type that's going to fit your needs the best and allow you to consolidate your existing funds, start contributing up to a maximum limit as long as you're allowed to, and have the income to suffice it, and get really rolling with these types of strategies. So why do people choose to self-direct? I pretty much covered all of these bases here. New source of capital, stock market fatigue. The one aspect I haven't really discussed yet is tax benefits. So a lot of people making investments with their personal savings then have to actually file taxes on the earnings that they generate from that investment. Or with real estate, you're looking at capital gains when you go to sell a real estate property that you own directly. When you make these types of investments with your retirement account, they're generating passive income back into your retirement account, and you're ultimately not paying taxes like capital gains and other sort of income taxes along the way of the investment strategy. Now, if you have a tax deferred account, a traditional IRA or a traditional component, 401k, HSA, those types of plans, when you distribute that money out of the retirement account, and with an HSA or ESA, specifically for non-qualified events, so not a medical expense or an education expense, you do have to pay taxes. That money gets added to your ordinary earned income. So it's not a specific hike on a tax, it's just money that you have to add to your tax return that filing year. When you make these investments with a Roth IRA, which can be a standard Roth IRA, or even now allowable in the SEP and simple IRA, and also the 401k side of things, that Roth money is effectively money that you've already paid taxes on. So you are able to generate returns passively in your account and never pay taxes on that money when you draw it out of the account, because you've paid taxes to put that money into the account at the outset. If you have other questions about tax benefits and tax rules and regulations, you could either reach out to us or go to our YouTube page. We've got other webinars that specifically focus on the tax rules and regulations. And before I turn it back over to Larissa, actually I have one more after this, I'm sorry. I got all mixed up with the numbers here. One of the biggest benefits of self-directed IRAs is that you can invest in what you know. I've kind of harped on that a few different times here. Real estate, honestly, is one of our #1 asset classes. About half of our client base are real estate investors in one way, shape, or form, but our clients use their own knowledge. So this is taking the money out of a fiduciary's hand, so out of someone else's hand, saying, oh, I'm gonna try to get you this type of return, but they can't promise anything. And it's a little bit more volatile, and putting that control in your own hands based on your own expertise, your own interest, driving your own dollars and having the keys to your own car as far as your retirement wealth is concerned. Over the years, we've seen really some great unique investments, both personally and by our colleagues. When we put this webinar on, we reach out to colleagues and say, hey, what's the most unique thing you've seen lately? So that's what we're going to kind of share with you a little bit further today. But I do want to just give you a baseline. So cryptocurrency is an emerging space over the past 3-4 years, and we've seen a real boom in that space. People wanting to invest their retirement dollars into cryptocurrency. The strategy and action plan for doing that has recently changed, so I'm sure we're going to talk about that a little bit. Farm animals and raw land. So it doesn't have to be development property that you're going to put a single family, multifamily, commercial use property on. You can buy actual raw land for timber farming or just for appreciation for farm. The actual animals can be owned in a retirement account in some capacities. Car carriers, 18-wheelers, airplanes, different transport type vehicles. Sports teams, yes, you can invest in your favorite or your local sports franchise with your retirement money. Movie projects, you can be a financier and a producer of a movie project with your retirement account. And burial crypts. I'm not the keenest myself on the whole death side of things, but there is money to be made there. And I will, at this point now, turn it over back to Larissa.
Great, thanks, Corey. So you can see, and Corey mentioned that, the idea behind this webinar is not really to give you all of these really incredible, different, unique things necessarily, although we're going to talk about that. But as Corey mentioned, the idea is using what you know to grow your retirement account. So as we go through this webinar, keep in mind that really that's why people are reaching out to us and asking us about these unique investments. It's not because they're like, oh, I'd really like to own a racehorse in my IRA, but it's more because they are in that industry. They work with racehorses. They know that investment side, that business side, and they want to grow their retirement account with their knowledge. So we like to say invest in what you know best. And so that's what our clients are truly doing when we're talking about these unique investments. So they may seem unique to us, but something like a movie project might be something that somebody deals with on a regular basis. And now they know that they can invest in movie projects using their retirement account. So we're going to start with cryptocurrency, which, of course, is not as unique as it used to be, but the idea of using an IRA to make this investment is sort of unique because a lot of times people are making those investments personally and they're just not sure how to make the investment through the retirement account. And there's, of course, 2 ways to do that. So the first way would be using an LLC. If you're not familiar with this term, checkbook control of an IRA or a checkbook IRA is something that is frequently searched. It is sort of a phrase that we use a lot in our industry where we're talking about giving somebody the ultimate control of their retirement account. We actually do a whole webinar on how checkbook control works using an LLC. You can also do it using a trust, but an LLC tends to be the most common way to do that, where you're setting up an LLC that is owned by the retirement account. So the single member of that LLC is the retirement account. We give you that specific vesting or wording, and then typically the account owner names themselves as the manager of that LLC. in order to have that control. The LLC then gets a checking account and investments are made through that checking account. So you can certainly do these types of investments through an LLC. And so what you would do basically is set up this LLC. You can name it whatever you want. So if you name it ABC LLC, then the IRA money is transferred over to the LLC checking account, and now you can make those investments. And so if you do that, then the investments themselves are titled in the name of ABC LLC in my example, and investments are made by you as the manager going forward. And that LLC can hold cryptocurrency, but of course, any other investments that you choose to make through the IRA, always, of course, at arm's length. And again, if you're unfamiliar with the rules, we're going to talk about them a little bit during this webinar, but of course we have webinars where we focus on those. But again, making investments for the growth of your retirement account and not your current benefit. And when you do that with cryptocurrency, what you're going to do is then work with the platform that you choose. The investment, so basically your profile and all of that, will be set up in the name of the LLC, and then you as the manager will make that investment. The reason we talk a lot about checkbook control when we're talking about IRAs making cryptocurrency investments is because a lot of times platforms will not allow the IRA to hold cryptocurrency directly on their trading platform. They're unfamiliar with self-directed IRAs. They don't like the third-party wire aspect of it. And so a lot of times you'll see when people want to use the bigger cryptocurrency platforms, they'll end up using an LLC in order to make it work. The other way to do it would be investing directly through the IRA, which is possible. You're just not going to see that as often as you're going to see the LLC setup. But there are a few cryptocurrency platforms that will allow IRAs to invest directly. What that looks like is basically setting up your profile in the name of the IRA. Again, we'll give you that specific vesting. And then as the account holder, you can make those purchases and trades, etc., all in the name of the IRA. So there's two different ways for you to do that. And ultimately, I think it will depend on which platforms you want to go with. Now, if you are looking at a specific platform and you're not sure if they were going to allow the IRA to invest directly, or you might have to have an LLC, if you have a contact, we're happy to reach out to them for you and discuss it with them so that we can understand what they might require in order for the IRA to do that directly. Moving on, we're going to talk about farm animals and farmland. We've had clients invest in things like racehorses, cattle, alpaca, all through their IRA, sometimes using that LLC structure. So setting up an LLC, the LLC again is owned by the IRA, and then as the manager, the IRA holder makes those investments. And we've seen shares in cattle, like I said, and racehorses. And the idea here is that even if they're in this industry, it still needs to be an investment made at arm's length. So they can't invest in the racehorse, that lives on their facilities, that they're responsible for, they're taking care of, but they can invest in unrelated third-party investments. So someone else's racehorse, for example, would be an acceptable investment for the IRA. We've had, investment into breeding different types of animals. We've even had loans secured by alpacas, very unique, a way to make an investment, again, investing in what you know best. I think Corey and I have both seen farmland invested. And so in my experiences, I've seen farmland purchased and then leased to a local farmer, or I think Corey also already mentioned things like timber rights for that type of investment, but I've seen farmland leased to a winery. I know that there's a lot of different ways to do that, but one that always stuck out in my mind was having a client buy orange groves, and then he joint ventured with a local farmer to harvest and share in the profits of those oranges each year. And it was just a way, again, to passively grow the retirement account, where he really didn't have to do anything, but he was interested in purchasing the groves. And so he did it through his IRA to help his IRA grow through that investment. I already mentioned vineyards. So we've seen vineyards a couple different ways. So, again, purchasing farmland and leasing it to a vineyard, but also private offerings. And oftentimes people say to us, well, we can't invest in alcohol, that's against the rules. But when you're investing into the business and not directly into something prohibited, that is something that you can do through a retirement account. So very recently, we actually had a webinar about investing in different types of, I think it was Corey, was it whiskey?
Distilleries in general, I don't know.
Oh, okay. Bourbon, I think,
Yeah.
was the topic. Yep. And then, again, you can't invest, you can't hold a bottle of bourbon in your IRA, but are you investing into a business that invests in bourbon, that creates, that holds, that stores, that sells, that distributes? Those are acceptable investments. So keeping that in mind when you're looking at these unique strategies and what you're considering doing for your retirement account. So again, private offerings, investing into vineyards, or companies that distribute bourbon or whatever it may be, but that will work within your IRA. We've also seen clients familiar with forestry utilizing that to purchase raw land, sell the timber, sell the rights for future timber production, and again, leasing land for farming, camping, and hunting. We've seen a little bit of everything in our time at Advanta.
Yeah,
Corey, I'm going to let you talk about ball clubs.
Perfect. Just to add before I do that, breweries, which is the second bullet point here, but breweries are something I've never seen a distillery. I think I'd get way too excited if that were an investment a client of mine process, and I would ask for a bottle. But I've seen clients in the upper Northeast. I don't recall exactly what state it was, but client invested like about $100,000 into private shares of ownership of an actual brewery that they were getting off the ground. So yeah, those types of things, as long as you're investing into the business, not the underlying actual physical liquid that's being poured, you're making a passive investment into a business, no matter what the goods or services that are being sold are. Pivoting a little bit here into ball clubs and other strategies. We've seen clients, I think Larissa and I uniquely worked together. This was back in my days as a client account manager, with a client that invested into ownership of a European soccer team. So basically that was structured through an LLC. This client with a number of other investors all put money into an LLC, and that LLC purchased a minority share ownership in this soccer team. So however that's structured, you may have enough money to help support your local regional baseball team or whatever sport that may be, or you may have enough money to be the next minority owner of an NFL team if you partner with other individuals and have an opportunity on the table to do so. But as long as it's structured appropriately and based on whatever the seller is looking to acquire financially, there are ways you can do that. Breweries, coffee shops. There's a flour mill that has some of their goods in the bakery aisle of your local grocery store that's partly owned through a Advanta IRA retirement account. There's lots of different things that you can utilize through these self-directed accounts. And then there's other things that are passive income generating businesses that get into a bit of a gray area when we're talking about laundromats, car washes, and self-storage. Those things become a gray area because these investments are supposed to be passive income generating, but these assets or entities, laundromats, car washes, self-storage, sometimes generate active income with their goods and services sold. So be mindful if you're interested in one of those strategies, there's a certain type of tax, unrelated business income tax, that you may be subject to paying. It may not be a deal breaker. It's just something to completely understand as you're specifically going through your underwriting process on the deal, if that's going to change your numbers significantly enough to where you may not want to make that deal or may want to structure the ownership differently. This is also a good strategy in those case scenarios, those limited partnerships, to possibly consider if you're a small business owner or self-employed, doing that type of investment through a solo 401k with possibly what's called a ROBS plan strategy, rollover for business startup. Those are more nuanced versions of this conversation that you would want to have offline with myself or Larissa. Speaking of those conversations, or at least referring back to your guys' questions you may have, I noticed a few minutes ago someone used the hand raise feature in GoToWebinar. Unfortunately, we do keep the audience muted for the duration of the presentation. So if you have a question, as we said at the beginning, maybe someone signed on a little bit late, please use the questions box on the GoToWebinar panel. We both have that up. We're reviewing those. If we don't get to them in the midst of our presentation, we have a slide at the end where we'll go over any questions that come in from the audience. And then owning an RV lot, that again falls into the real estate asset category, but you can own an actual unit, an RV unit, or a entire lot, whether you're doing owner occupied units and just basically leasing the land, or owning the actual lot that people live into. And uniquely enough, we've seen one held in an account with us that is a nudist community. So not something you could actually live there on the property. You can certainly go on site and inspect if you want to. That came out kind of creepy, didn't it, Larissa?
That's okay. We did have a question pop up. Can I invest in a startup that I'm already a partner in? That's going to be a gray area. Thank you for the question. It does depend on a few different things. Your percentage of ownership is going to be the primary thing to look at, but we can certainly refer you to attorneys that can answer that question for you and give them your legal opinion. I see you responded 50%. That is true. The sort of line that they draw is 50% ownership, but there's a few other things too. So how much control do you have? Do you have the controlling, percentage? Different things of that nature. We're happy to discuss this with you offline, but ultimately that's probably for an attorney's legal opinion on that. But there is the potential there, but there is going to be some things to navigate. Another question that popped up, can I use my IRA to purchase 40 acres of raw land I personally own, paying fair market value? Unfortunately, no, because you already own it. So I like to say the investment has to be new to you and new to the IRA, and that's going to be very important. And there are also disqualified individuals that you don't want to purchase that from as well. So even if you own it in an LLC, it's still going to be prohibited. Your IRA has to make an investment that is brand new. And we'll talk a little bit about the rules as we get to the end of the webinar. Keep those questions coming.
Thank you, Larissa. So the next unique strategy we wanted to talk about here is transportation. I alluded to this earlier with respect to 18-wheelers, like on this specific page, and also like airplanes and other transportation devices. So a non-client has a transport business with a contract to move cars from a train station to a local dealership. He needs more car carriers or 18-wheelers, but doesn't have the capital to do so. A friend can use his retirement account to purchase the car carriers and then lease them to that friend's business. Now, you may be thinking, if you're familiar with the IRS rules, you're not supposed to hold an actual vehicle like a car or something like that because it's a subjectively valued asset. This is seen a little bit differently because this is an income producing asset. This is a car carrier. While it is a vehicle, the actual means for this vehicle is moving different assets from place to place and generating passive income in doing so. 18-wheeler mechanic found a truck at a discount. So if a client is a mechanic and finds a good deal, then they can purchase it and resell it to a third party after the mechanic does the work. So generating some income, very similar, if you will, in a real estate capacity to an option contract almost. You buy it, you rehab it, or find a better buyer for it after doing a little bit of rehab in this case. So kind of akin to fix and flip or real estate option contract.
And just to be clear too, that the mechanic cannot, if the mechanic is the IRA holder, then he cannot provide that sweat equity. So he might have a friend in the business as well that he's sort of working with in order to do that, or he's funding the project for the friend and they have maybe a joint venture agreement. But again, remember, not providing sweat equity to your IRA. And again, we'll talk about this as we go through the webinar.
That's good to note, Larissa. I know on the screen here it says third party. I'm not sure if I mentioned that, but that also raises another factor in this scenario. The 18-wheeler that's being purchased by the retirement account investor, even if the third party mechanic's doing the work, it also cannot be stored at the account holder's residence or at their garage or something like that. It has to be stored off-site somewhere that this direct account holder owning the 18-wheeler in the retirement account does not have necessarily direct access to touch, like can't walk into their own garage and tinker with it or something like that. So that's just an additional aspect to note there. Before I move on to the next slide, I see one more question that popped up. I have a client currently in a traditional self-directed IRA with real estate. He wants to switch custodians. Are you able to take on this type of client? The answer is yes. We take on clients with what's called in-kind transfers all the time. So this client can set up an account with Advanta, complete the transfer request paperwork to do what's called an in-kind transfer. The assignment of ownership is drafted up, so we take on the asset. They don't have to liquidate their specific investment, move it to us, and then rebuy that investment or a similar investment. We can definitely help that investor with that switch over. Another aspect of transport, an airplane's purchased through an IRA via a single member LLC. So a client paid a non-disqualified pilot to fly it where he needed it to be and arrange storage at a small airport or airfield. So again, the client isn't doing any direct sweat equity or labor here. He's purchasing the asset. He's using a non-disqualified person to move the asset, and then it's stored at a third-party facility. He also paid the expense for the pilot to get back home. That can be negotiated. Assumingly you don't have to pay that expense, but you probably want to do well by the person flying your brand new asset through the sky for you. The airport or airfield that the asset, this plane in this case, is stored at has to be paid out of the retirement accounts LLC. And once the plane is sold and the buyer picks it up, the income generated flows back into this LLC. So completely passive income strategy here. The cash flows in and out of the LLC in this specific scenario, and everything is pretty clean and pretty similar to the last reference with the 18-wheeler. And burial crypt. So this is actually one of Larissa's, if I'm not mistaken. Again, I get a little bit creeped out by this one. But we've had a client that had an opportunity to buy 2 side-by-side burial crypts. They were selling at a premium, but he was able to talk them down to a discount and then resold them to another, I'm going to be punny here, end user. So this can't be an asset that you purchase and ultimately intend to be buried there yourself. It has to be sold for a profit. So don't end up doing something like this with the intent to just distribute it out and use it yourself in the end, or pass away and then get put into that crypt. It has to be basically seen as a real estate deal. So you're buying a piece of real estate that happens to be a burial crypt. You're buying it ideally at a discount, selling it at a premium, and basically it's as simple as a basic real estate transaction.
If I recall it's also treated as deeded real estate. It's been a little while since I've thought about that structure, but I do think it was treated as deeded real estate, which is interesting.
That should be correct, if I'm not mistaken. Even like a 6-foot hole in the ground at a graveyard is treated as physical real estate. Just from personal experience, having relatives have passed away. All right, that's enough talking about dead people. All right, so some of the key components that Larissa and I just covered are the structures of the deal. Every example we showed you, we kind of talked you through how that investment was facilitated from a deal structure. So we talked a lot about LLCs, or limited liability companies, and private placements. We talked about prohibited transactions, so what you can and cannot do, who you can and cannot transact with in the grand scheme of these types of strategies. And we also touched base a little bit on the possible tax liabilities for different strategies, like the unrelated business income tax I referenced, and the fact that these assets are supposed to be generating passive income that you don't pay taxes on when you buy or sell the asset. You only pay taxes later on when you distribute that money out of your retirement account to utilize for your retirement income in the future. Larissa, I believe I'll turn it back over to you for our case study here.
Okay, great. Thanks, Corey. And just a reminder too, we do have a webinar where we cover prohibited transactions and disqualified persons. So if you're interested in that and you're unfamiliar with the rules, please feel free to reach out to Corey. or myself, and we can help you get the link. You can certainly check out our video library and search for it, but it might be a little faster for us to pull that link for you, and we're happy to do so, so feel free to reach out to us. And now we're going to start with our case studies and how investments are made in retirement accounts. What does that look like? And so we're going to start with private placements, because although a lot of these unique investments sound like they would be very complicated, a lot of times they come down to simply an LLC or a limited partnership where an IRA is making that investment. So actually at this point, it was a lot of years ago. It feels like it was yesterday, but quite a while ago, we had clients invest into a movie project where basically they were investing as limited partners. And so we heard about this movie project, a client brought it to us and said, hey, is this an investment that I can make? And we were like, yes, as long as this isn't, for your own current benefit, then you can make the investment. And it ultimately came down to just some paperwork. So we got the limited partnership agreement and the any documents that applied to the investment from the client. And we helped them make sure that the investor was shown as the IRA. So you can see in the right-hand box, Advanta IRA for benefit of Joe Smith, IRA number 1234, or whatever it is, basically demonstrating to the IRS that this is an investment being made by the retirement account. And when you're making an investment through the retirement account, although we are going to have you sign that paperwork as read and approved, because we are not doing due diligence on your investment. That's super important. You want to make sure you're doing your own due diligence, and you're reviewing the paperwork to make sure that you're agreeing to, whatever the parameters of the investment are. We're going to have you approve it. And then once you approve it, Advanta IRA is actually the legal signer for your IRA. So in this case, when we got the movie project paperwork, we reviewed it. We made sure that it showed Advanta IRA for benefit of Joe's IRA. We had him approve it through DocuSign. And then once it was approved, we signed it and then funded that investment. So Joe could do that directly through Advanta IRA. So in this case, again, it was a private placement. We got the documents and then helped Joe make that investment, but he could also do it through an LLC. So again, a lot of these really unique investments sound like they're going to be complicated, but it's just paperwork. It's, however Joe decides to structure it, but ultimately the paperwork is going to show the IRA as the investor. So if Joe uses an LLC for checkbook control, like we discussed earlier on in the presentation, then his IRA would be the sole member of that LLC with him as the manager if he chooses. And then ultimately he is going to either have his attorney create an LLC, where again, he needs an operating agreement showing who the single member is and who the manager is, with all of the information included in that operating agreement that you would typically see. And then Joe will turn it over to us, sign it as read and approved. We review it to make sure we see the IRA as that sole member, and then we sign it on behalf of the IRA. And Joe will open a checking account in the name of that LLC for the IRA, and then we fund that LLC checking account. And now Joe can turn around and make that investment for the movie project through the LLC so that it shows the LLC as the investor. He can also receive the income from that and deposit it to the bank account and make new investments all through that LLC checking account. So again, it kind of gives him that ultimate control. Now, in the case, especially of this movie project where it was originally a limited partnership, he doesn't necessarily need checkbook control, but some clients really do want that ultimate control. And it's just important to realize that when you have that control, the IRA is usually 100% owner, with the IRA owner as the manager. And it does allow that management, but it also has the IRA owner doing all the record keeping for the investments within the retirement account through that checking account. So funding investments, paying bills, signing contracts, receiving income, all of that is done through the LLC checking account. And it's up to the IRA holder to make sure that they're comfortable, one, being the manager, and two, taking on the record keeping, making sure not to engage in prohibited transactions. When you have an IRA custodian basically handling your record keeping, they're going to help you through that process. And when you have checkbook control, you're going to be doing that on your own. So make sure that you're comfortable with it. Oftentimes you'll hear of IRA custodians offering, one-stop shop, the opportunity where they'll set up the LLC, they'll also set up the IRA, and they'll help you do that. There's no secret formula for this type of LLC. It's going to be a single member LLC. You want to make sure that you're not paying yourself as the manager, and there's no language in the operating agreement that would be considered prohibited. But ultimately, it is just simply that, a single member LLC. And if you're interested in reading more, because a lot of times people hear about this strategy and they say to themselves, how can this be permitted? This is not an arm's length transaction when you're acting as the manager. But the tax court has allowed it, and you're going to see 2 court cases that we cite often when we talk about checkbook control. So Swanson versus Commissioner is the first one, where basically the IRS did not like that Swanson had checkbook control over his IRA with this structure, but the tax court not only allowed it, but ultimately Swanson was able to sue and get his court costs covered. And so that's why it's cited as Swanson versus Commissioner instead of the other way around. And then the tax court memo with TL Ellis just further reiterates that you can't pay yourself as the manager, but as long as you're not doing anything prohibited within that LLC, then the tax court is going to allow it. Corey?
So, yep, sorry. So the self-directed rules, we've referenced them throughout the presentation. You're not able to invest into life insurance policies or hard to value collectibles like antiques, artwork, fine wine, basically anything that would be seen as a subjectively valued asset. One of the favorite examples I like to use is I used to have a neighbor, and they had an old, rusty, not running 76 Stingray Corvette in their driveway. They, I'm sure, thought that with a little bit of elbow grease that they were never going to put into this vehicle, it would be worth a lot of money. I thought it was worth the scrap metal it could be sold for. That type of asset is something that the IRS does not want you to hold. So just put that into perspective, just subjectively valued. If I think this and any other person thinks that there's a completely separate value for it, those are things the IRS doesn't want you to invest into with your retirement account. Now, it does say coins are not allowed, but there are some coins that are allowed if they're value-based, and you're basically trading on the value of the metal. So we call it precious metal investing. We don't call it coin investing on our end. You're buying and selling based on the bullion value of the actual coin itself, the raw metal that the coin is pressed into. There we go. Disqualified persons, we've referenced that a few times. It's really easy to illustrate this on the right-hand side of the screen here. There's an example, but in simple put words, it's the main trunk of your family tree. So picture your family tree, cut off all the branches because those are not considered disqualified. Your parents, your grandparents, your children, your grandchildren, everyone on your lineal tree, ascendants and descendants, as well as your spouse, and extending to any businesses that those individuals control day-to-day operations of or own 50% or more of, as alluded to with the client's question earlier in the presentation. Those are entities or persons that you're not able to transact with, meaning I can't buy an asset from one of those disqualified persons, or I can't sell an asset to one of those disqualified persons, or I can't let one of those disqualified persons benefit from an asset in my retirement account. I can't go buy a rental property in the town I'm sending my son to school in for college and let him be a tenant. Sure, his best friends could be tenants at the property, and technically speaking, he can go over there and visit them, but he can't, as my son, be the handyman to change out the flooring or change the light bulbs or fix the toilet if his friends busted it or something like that. Now, as I mentioned a moment ago, we're cutting off the extended branches of this chart because non-disqualified persons include siblings, aunts, uncles, cousins, other distant relatives, friends. So you can transact by issuing a loan to your brother or buying an asset from your aunt or your uncle. So important to understand these rules because sometimes people do, as was even asked in today's presentation, want to purchase an asset that they own personally with their retirement account, or maybe want to use their retirement account to buy their parents' home and help them be a little bit more financially stable in their parents' older life. But technically, with the IRS rules, those are things that you cannot do. Unrelated business income tax, I referenced it earlier. I knew that we'd talk about it a little bit further here. That is a tax levied on income that is not specifically passive income. So when you're making a private equity investment into a laundromat, a car wash, a storage facility, or things like that, you're possibly generating some active income, and you do want to make sure your CPA or tax preparer is understanding of this and gives you good guidance and feedback if you're at a threshold or level where you do need to submit and pay UBIT tax. Unrelated debt financed income, we didn't necessarily talk about as much today. That's more so for our real estate heavy webinars and content. But that is when you're making an investment where you're utilizing financing or leverage, and that UDFI tax is levied on the portion of the investment that's leveraged. So if you want to buy a $100,000 asset, but you need to take out a $40,000 loan in your retirement account, you're ultimately going to pay UDFI tax for 40% or $40,000 of the investment. And UDFI tax is taxed at the trust income tax rate, which I believe is 39%. So a lot of times that is a deal breaker for those investments, or at least a point where people pivot on their strategy and find another way to make that investment work for their numbers and everything. Also, as I referenced earlier, that may be a point that a solo 401k may be a better account type for someone looking to utilize an investment that may involve UDFI tax, because 401k plans are exempt from UDFI. So a little bit of benefit of knowing what plan type is going to fit your needs the best, and a little bit more insight as to who, when, and how you should speak to when you're doing underwriting, considering various strategies here. All right, so this pretty much concludes our webinar today. The key takeaway points I want everyone to understand is that your retirement investments can be unique, personalized, and creative. You are not limited to just stocks, bonds, and mutual funds. Don't let a financial advisor tell you that this is too risky or too cumbersome to take on. If you've got the interest and you've got the money in your retirement account, you should be the one making those decisions and not getting talked out of it because a risky asset class like stocks, bonds, and mutual funds seems to be less risky than actually something that you know intimately how to do, or have a interest and an actual passion to learn more about and put your money into those categories. You'll feel much more fulfilled in many cases, instead of saying, oh, I've got my money in an index fund, or I've got my money here, as opposed to saying, oh, I invested into this sports team that I think is really cool, or have this unique story as to how you're generating money. So take it for what it's worth, but it really can be as unique and personalized as you want it to be. Always conduct your due diligence thoroughly. As Larissa said with our disclaimer, and she said again during her portion of the presentation, we don't do any underwriting on any investment our clients make. We simply make sure that the deal that's brought to the table by the client falls within the IRS rules and regulations. We help in that capacity, understanding how to make those structures and how to make the deals work, but we ultimately aren't giving any feedback to say, oh, this is a good deal, this is a bad deal. Oh, this is someone you should transact with, this is someone you shouldn't. We say, oh, you can transact with this person, or you cannot based on disqualified persons rules. But ultimately, it's up to you to do all your own underwriting and due diligence, or consult with your own CPAs, attorneys, tax preparers, providers, etc. And finally, diversifying your retirement portfolio can help protect your nest egg during an unstable market or fluctuation, or in a real estate bubble. So verifying what type of market conditions and what type of risk factor you have is very important, because obviously this is your nest egg. This is either tax deferred money or tax-free money that you're planning to utilize when you no longer want to work later on in life, or are no longer able to work later on in life. And we always want to see our clients succeed and see our clients have that nest egg ready as big as possible for when their day-to-day working is done and they're ready to just relax, or maybe they need to step away from work for, you know, whatever purpose they have, and be ready for that point in your life. We really hope that you walk away with those key points and with some great new information about what you can do with your retirement funds. I do want to share that we put on these types of webinars at least twice a week, typically every Tuesday and Thursday from 12 to 1 p.m. Eastern time. If you register for any of our webinars, you'll always receive a copy of the recording emailed to you within about 24 hours. And you'll also be able to go to our YouTube page at any point in time. You could go to it right now and watch back any of our webinars. So if we talked about something or hit on tax rules or a certain type of investing that we didn't cover here today, you can go to Advanta IRA on YouTube, find any of our previous webinars and watch them back at your own pace, at your discretion. We have a podcast that our colleague Alex Perney hosts. It's called the Alternative Investing Advantage Podcast. So you can check that out anywhere you find your podcasts. It's a more free-form conversation with experts in various industries of investing. And it's not as strictly educational as these webinars are. So you may get a little bit of insight from our guest speakers on the podcast. And it's very insightful for people that are looking into this strategy and looking into these types of investment opportunities. And we have a blog on our website as well. If you're interested in industry news or in an election cycle, upcoming legislation that may affect retirement account investors' ability to do things, you can check out our blog on advantaira.com. I'm always proud to say there was some legislation that went around in one of the previous election cycles that was worded to take away checkbook control. The single member LLC or checkbook control strategy from self-directed investors. And if you recall, between Larissa and I, we talked about checkbook control being a vehicle for these unique strategies on probably 4 or 5 different occasions throughout this presentation, and they wanted to take that away. So we started a change.org petition, we put stuff on our blog, and we actually helped raise enough signatures to get that aspect of that legislation taken out. So we did protect and reserve the checkbook control strategy, maybe not ourselves, but in part for the retirement account investors in the US. So I'm really proud to say that. All right, I do think I saw a few questions pop up as I was kind of wrapping up those last few slides. Larissa, you know where the first one may have started? We could go back and forth with those.
Yeah, absolutely. So the first question that popped up was, can I make a loan to the business? I think this question popped up because you were talking about prohibited transactions and disqualified persons. So I would answer this by saying, can you make a loan to your own business? Again, dependent upon the percentage of ownership and how involved you are in the business. It is something that you could potentially do. You do not want to sign the note. That was a in case law several years ago where the business owner at some percentage also signed the note. And so that would be something that would be prohibited. But again, based on percentage of ownership, your involvement in business, your IRA could potentially loan money to a business you're involved in. But I would encourage you to talk to an attorney before making that investment. Corey, another one that popped up regarding unrelated business income tax. Interest being received by a bond invested in oil and gas company, is that going to be subject to unrelated business income tax?
Sorry, interest being received from an oil and gas investment with UBIT tax. I actually just did a webinar with an oil and gas provider, and I believe the answer was no, because that bond and the way oil and gas companies typically structure their deals is into physical real estate. So that's income being generated by the piece of real estate and the lease that you have on that. I'm not as familiar in all of the oil and gas strategies, but typically speaking, from my experience and the feedback I've received from an expert in that field of oil and gas investing, is there is no UBIT specifically associated with those investments. I may be slightly wrong, or there may be a niche version of that investment strategy that it does apply to, but from my experience and what I've been told and heard, no UBIT or UDFI would not, UBIT specifically would not apply.
And you know, maybe a little more specifically is typically where you're going to see investments made through the IRA receiving either interest income or dividends, and these would be considered passive income strategies pretty typically. I mean, there are exceptions, of course, investing in real estate that has financing and things of that nature, but typically you're going to receive passive income back to the IRA where unrelated business income does not, unrelated business income tax does not apply. Another question that popped up, wife is a realtor. Can she sell or buy real estate property for the husband's LLC owned by an IRA and receive the commission? And Corey and I probably get this question all the time. And I understand that the commission is paid through the brokerage. We're going to leave this up to you. Ultimately, you have to decide whether, you know, this is going to be providing a service to the IRA, which she would be prohibited from basically providing a service and receiving a benefit from that. But I know I've spoken to different realtors. They talk about how the commission is paid by the brokerage and how they're providing, you know, their expertise. But ultimately, would this be considered a service? Probably, maybe. I don't know. Corey, do you want to speak to your understanding of it?
Yeah, in my experience on the account management side, where I've seen transactions like this occur, it's always been my input, and again, this is not advice, this is my input just from experience. It's easier and cleaner of a transaction just to zero out the commissions and structure the deal so that's in some way, shape, or form, you know, identified, and the deal gets maybe a little bit sweeter in other ways. But compensating through the broker can work. It's just very important that the compensation has a clear paper trail, that it never went to this client's wife. So it can't go to the broker and then, you know, if the wife is ever audited, have it seen that that broker just paid out a cash transaction back to that wife or something like that in the future. So it's always cleaner just to maybe raise the price on the deal and just zero out the compensation or commissions. But we don't have necessarily an input there to sway a client one way or the other, as long as it's clean from the IRS rules, which can be done either of those two ways.
And another thing too is, I know as a real estate agent, a lot of times you have a lot of friends in the industry, and this might be a good time to engage a friend to work with as your real estate agent. Again, as Corey mentioned, just to keep the transaction nice and clean for your IRA's benefit. Another question that popped up is, I don't think my self-directed IRA investment shows the custodian name first, so i.e. Advanta IRA for benefit of. It probably does, because we're very specific when we do our paperwork, but we're happy to look at that with you. So I'm guessing you're a current client, and if you post that question and you'd like Corey and I to review that with you, we're happy to. But our paperwork does go through a few approval processes just to make sure that the IRA is properly titled. But again, you can reach out to me or Corey, and we're happy to look at that for you. Corey, there was one more question that popped up.
I see this final one here.
Yeah, how about, and if you do have any other questions, we're happy to answer them. Just make sure that you get them typed in for us. So about investing in a self-directed IRA with gold bullion outside of the country, especially for tax advantaged countries. Also real estate investing outside of the country like Dubai, Singapore, etc.
So I think those answers can kind of be answered one and the same with respect to the IRS's rules and regulations. The aspect of especially tax advantaged countries, using a retirement account is itself a tax advantage. So you may not be able to take advantage of those types of things because you're already utilizing a tax advantage entity, your US-based retirement account, to make the investment. So similar to other real estate deals where buying real estate with your retirement account doesn't let you take advantage of depreciation and things like that, write-offs, because you're buying it with a tax sheltered vehicle. I don't know that those aspects would apply. But in the grand scheme of purchasing gold, precious metal outside of the US, in line with real estate outside of the US does not restrict, or the IRS more specifically, does not restrict you from making those types of investments. What you really need to look into in this example is Dubai's rules and regulations or Singapore's rules and regulations. As far as a US entity, your retirement account, making a purchase there of land in that jurisdiction. I, for example, have seen plenty of clients invest their retirement account in Costa Rica. And while the US doesn't have any restrictions, Costa Rica specifically will not let a foreign entity purchase real estate there. So a US-based retirement account would have to set up a Costa Rican-based equivalent to a checkbook LLC in order to make that real estate investment in Costa Rica. And that's always part of the client's due diligence, is to do your research. I think Larissa and I have done a webinar specifically on international investing once every year as well for the past 2 or 3 years. So go ahead and check that out if you want more detailed information there. But in general, you're allowed to, based on the IRS's rules. What you really need to do is look up the rules in the area you want to invest and see if they need a foreign entity set up in that area. If you can buy it directly in your retirement account for your own purposes, decide if maybe you want to structure it through an LLC vehicle and not directly through the retirement account. Those are the considerations to be made.
Yep, actually, Corey, you're exactly right. We do that webinar usually once a year, Investing Without Borders. And so we're happy to email that presentation to you if you'd like to learn more. I don't see any other questions, so we're going to wrap up the webinar. I did put our contact information up here again for you. The individual that wants us to reach out, please feel free to email me or Corey, and we'll help you with those questions. Anyone else that has questions that they maybe felt like they did not want to ask the question during the webinar, please feel free to reach out to us. The recording for this webinar will go out soon. The handout is in the right-hand navigation under handouts. And you can also email us for the handout if you did not have a chance to download it. We thank you so much for joining us, and we hope you join us for the next one. Again, webinars are twice a week, again on Thursday, and we hope to hear from you soon. Thanks, Corey.
Yep, thanks, Larissa. Hope everyone had a great time.